Right, we are live. Ben joins us from an undisclosed location in the Emirates, so he doesn't get included in any targeting packages. We are going to leave it light on the geopolitical LARPing this evening. Frankly, no one has an edge here, but we are going to talk about deleveraging. For those of you that caught the show on Thursday, where we had the wonderful JJ John Johnston. We talked about the silver market, in which he is a 50-year trading expert. And everyone loves to sort of talk narratives when it comes to these crazy bubbles. But really what we saw with the Christmas tree of death in silver over Christmas, New Year was a deleveraging. The question is, where does the deleveraging story happen next? Hey, Benny, hope you're safe.
I am for now. What a crazy... That was a crazy 24 hours, and I have no idea what my exit strategy is out of here, but I'm here for the show.
Yeah, you're not swimming at.
No, I looked at that. That's the land and swimming options are rough. Driving through the Saudi Arabian desert and then getting to Iraq or taking a boat. Maybe getting through, the military ships and rockets, but then you got to deal with Somalian pirates, and then you're kind of just in the middle of the Indian Ocean. So there's not a lot of options when the airspace is closed.
Okay, well, I guess the UAE needs to keep all the tourists it's got for now, because it's probably not getting any more for a while. And maybe we should just start there, just in terms of, you've been hanging out with a lot of locals in Dubai over the last few days. Give me a sense of where their heads are, because a lot of people are there for tax reasons and convenience. They didn't count on a tax rate for missiles trade.
Well, like they say, there's a price for everything in life, and sometimes an arbitrage that seems too good is maybe just too good. And yeah, I think, look, there's a lot of people here who are residents who don't need to be here, kind of here because it's nice. And they sold this Switzerland wrapper. And I think that I've talked to a lot of people who are not really ready for missiles over your head, including yours truly. That was a lot. Yeah, I'm from Madison, Wisconsin. They teach us how to drink and be tough, but they don't prepare you for missiles over your head.
Tough in hockey matches, not tough in missile strikes. So listen, let's kick things off. Let's talk about, let's get on topic. Let's talk about this deleveraging. Let's start with the bonds, right?
Yeah, so it's I like to have fun with the AI and stuff. Look, I mean, a year ago in January, February, when rates were close to 5%, and there was no bond bulls to be had, I kind of started emerging as a bond bull and telling people, I'm pretty bullish. And at the time, I was just mostly messing around with SOFR, and I think me and you were both involved in the Z6s at that time. And now we're in the 7th. What's a year later? So, just so people understand, like when you trade SOFRs at the end of a cycle, so you're anticipating rate cuts, you want to be at like the, point where you're getting the most bang for your buck. And then like right now it's still, that's giving you almost 2 years of runway to get back to zero or, close to zero. And so there was a point, I don't know, Rupert, when was that? A couple of weeks ago when I swapped out from H7 to Z7, and that was a great move because we've caught like maybe 9 to maybe like 11 basis points in compression between. Yeah, I think it's 11. So that was pretty good. That chart right there is just, the Treasury index, the Treasury Bloomberg index, and then the Z7 is the white one. And, look, for all the hate, including Rupert, that people want to give on bonds, those things have been pretty steady this whole year,
I love the convexity at the front of the curve, and you can do very you can create very convex situations on that view that there could be a rapid and aggressive cutting cycle. I still worry about long duration fixed income, right? For all the reasons we've discussed before, which I'm not going to go into. I'm not convinced, and we don't have to debate this now. I'm not convinced that the inflation genie is back in the bottle, particularly not now if we've got the roar of one of the horsemen in the form of crude markets. we're expecting to see Brent open at 85, apparently, in a few minutes.
Let's see where it opens. Things just open. Let's see where we're at. Keep going. I'll just take a look.
Yeah, I'm too cheap. I'm too cheap for live prices right now.
Yeah, 73 for WTI, so up 8%. I was thinking like 9% ish. I mean, it's a good move, but like
Right.
nothing world beater. Gee, you can go back for a second on that,
Yeah.
and just what I would say is that the bonds basically, people are like, because PPI was hot on Friday, right? And so the Chicago PMI was good. And so what I would say is if you go back to like an '08, for example, we had 5% plus inflation that summer. And that was all anyone was talking about, and oil was high. And so what happens in a deleveraging, to come back to the title of the show, is that it just overwhelms, right? So remember, there's 80 trillion of US total non-financial credit out there. And so, when that starts to come in, and go back to the title, Kinetic Deleveraging, like basically static deleveraging is kind of flattish. It's not picking up speed or acceleration. Kinetics, when the ball, the snowball keeps rolling faster and faster down the hill. And so I think that's what it is, because, bonds were super bid on Friday. Now, you could say, okay, people were nervous about the weekend with Trump and Iran and why I'm stuck here, and that's fair. But I'm just saying that chart for the year is showing you this isn't just a one-day event or, a near-term event, right? So let's go to the next slide that you just had up.
Yeah, I mean, so this is where we are in credit, and the credit trade has been, the dog that didn't bark really for the last 18 months, right?
Well, not in private credit, right? So, like, personally,
well, sorry, I'm talking about sort of high yield CDS, right? Obviously,
right.
God, yeah, your private credit's a very different story.
Yeah, and as a guy who's owned high yield CDS, like, I feel like an ass because it was just kind of a lazy man trade. It's kind of like when you're like, oh, I'll buy some SPY puts when you're nervous. And, I was short Blue Owl, but just as a position, like, and it ran, whatever. But it was not like the CDS where you have like a gigantic position. And I think there's going to be a catch up. But let's be clear, like KKR, for example, is near the liberation lows right now. So this deleveraging started last July very quietly in the the height of the fun summer, and then I think it picked up in let's call it August, or maybe September, when we had that first brands and all that stuff that got up. So these things, if you go back to the 05 to 08 cycle, it's a process. A true credit cycle is a process, whereas a deleveraging in the options or financial markets usually is very quick. It's like very sharp, very fast, and then it kind of the leverage is burned off, and then we come back.
So this would just put together. I mean, this is the financials cracking ahead of the broader market, the S&P, in late 2007, right? And one wonders, I mean, the software story is so tied up in the private equity, private credit world. One wonders if that's the right analogy to be thinking about it. Are we waiting for the broader market to catch down with what's happened in software? I mean, we'll go back to the Horsemen in a second, but I just thought it was timely to chuck this slide in.
Yeah, I think that's
and
right.
As ever, folks, if you are on our distribution list, you will get a copy of these slides, and it's a great deck today. Okay.
Yes.
So back to the Horsemen. Let's carry on with credit, right?
Yeah. So let me just explain this concept of the four horsemen. I mean, everyone loves to say the four horsemen from the biblical four horsemen, but I like to think in markets there's four horsemen that kind of drive things on how market mechanics work. You have credit, you have volatility, you have oil, and you have the dollar. Basically, it's a global dollar system, much to Rupert's chagrin. So like we said, credit has been. We just saw the slide, high yields, it's coming up. We've gotten 42 basis points in the last couple, it's been steady up for 6 weeks, but that's still very low, right? And that's also including the swap spread. So, in cash, it's even lower. But here's what I think. I think that the private credit is the subprime this time. And if you think about like subprime, that was really issued from the 02 to 05, the really bad paper. Like, the really bad paper was posted, but like they really were getting that paper out the door, and like you had 5 years of shenanigans. Well, if you really think about like 18 until 2021, maybe 22, there was a lot of bad paper. There was a lot of software bought. There was a lot of VC. There was just a lot of stuff that was shenanigans.
Okay.
And the difference.
Just 1 second. 1 second. One problem I have with the subprime analogy is the liability structure on the other side, right? Back in the GFC, it was highly levered commercial banks that were along this sort of toxic asset. With the private equity complex, a lot of that is evergreen capital tied up in offshore insurance companies. So there's less of a liquidity gun to the head. Now, I don't know how that whole insurance setup plays out. Sounds like it's a taxpayer money solution in the end again. But there isn't the Lehman funding in Japan on an overnight basis that we had back in 07, 08. Right, so it's got time, and this is a feature, not a bug. This is why the system is set up as such, right? So that there cannot be this overnight gun to head on the shadow banking sector, right? We can't listen. These private credit funds are getting gated now. No one's getting their money back, right, until this thing sort of settles through the system.
Totally. And so when I say it's the subprime, I don't necessarily mean it's the exact same scenario as then. What I'm trying to say is it's the shit paper, right? And then that shit paper was in the banking system because post GFC there was regulation rules of why we created this shadow banking system to be big as it was. It's like all the same guys that just, instead of working at the bank, now they worked at KKR or Apollo or you name the firm. They're still bankers. They're still doing the same stuff. They just moved on to a different area that had a better liability structure.
In many cases, it's the same people. It's the guys from the sort of Goldman leverage finance desk.
Exactly. Yeah, exactly. It's literally the same guys, same assholes. Like, no offense, they're nice guys, but I'm just saying.
There are some nice capital markets bankers.
Yeah, they're all. Cool. You're the best one. But the point is, that was like everyone was like, oh, subprime's contained. It's only like $1 trillion or 800 billion. Or whatever. This is like 1.5, so it's like of 80 trillion of non-financial credit. It's not that big. But when you think about, again, the kinetic energy thing, this is a gap, and then there's a refi window coming up. And remember, you're right about the private equity guys, the private credit guys, but let's be clear who underwrote a lot of that. There's bank loans that are under that stack. And so you're going to have a situation where the bank loans and the loan market has actually kind of been much more in the underperforming basket. And I didn't put that slide in there, unfortunately. I should have done that. But this is one of the key things of why I think the Z7 is going to go back to 99 plus, is because, as we see this stress and the implied spreads in the private credit are probably 1,000 to 1,500 basis points now, which, we're in a level of stress then. Now, some of that's illiquidity, don't get me wrong. So it's not perfectly comparable to, the public back then. But you're going to see that they're going to need to, in this next two windows of refi, they're going to need to take as much relief as they can to help their loans out. And, the easiest way to do that is take, 300 basis points off the short-term funding rate, right? Or the SOFR and or the policy rate. And so that's one of the things I think is like one of the key mechanical understandings is that the banks just issued a ton of NBFI debt or credit, whatever you want to call it, to fund this. And now, as you saw in that chart before, they're deciding to put it back. And I think they also incrementally want to take some of that business. My buddy Charlie Peabody's talked about this a lot, that business, they would like to have that business. And so, I don't have an opinion on these, private credit, private equity stocks as they got beat up. So, and I don't know them, as well to have talk about this publicly. But I'm just saying that that is something to be considering basically in that situation. So we can move on from this. So
I think there are easier trades now, right?
Yes.
Than piling onto that one. So the next Horseman. I mean, listen, every single geopolitical spike in crude prices has been faded. Is this the same? You know, I mean, it's already off its highs, right, of the open. I'm looking at slightly delayed prices, but I mean, I just have a hunch.
It's WTI $73. It's kind of like where it is.
You know, I see on Twitter tonight a lot of the guys. Hey, me, you know, me after shorting the spike on Sunday night in crude. You know, walking into his Maserati on Tuesday. I just have a hunch that that's not working yet. I don't have a position at the front of the curve. I haven't traded the front of the curve for ages. I have my Squirrel Special Petroleum Reserve, my SPR, which is long dated Brent and WTI contracts. I think this is the spike you fade at your peril this time.
Yeah, I mean, my since I'm in the Middle East, like I've had some talks with people, and one of the things I tell you is that like these, I saw live for the first time in my life missiles get intercepted coming to the city I was in, which was a very eye-opening experience.
Right, Harry.
And it was hairy, yeah. But these interceptor systems that they have in the countries that are getting attacked only last 3 days basically of capacity. Well, tomorrow's the third day. So I think this is speculation, is that, people all come and want to fade it because that's worked many times. And then, basically maybe we'll get a little fade. And then let's say this thing accelerates midweek, because how do you affect the US? What does Trump care about the most? The stock market, right? Well, if we got like a Tuesday acceleration or something crazy, that would be, I think, when you'd actually get the 20%, 30%, the move. And so we'll see how it plays out here. But
yeah, well, let's talk about equity risk in vol terms here, right? Obviously, sort of at the index level, right? Compressed vols, starting to see a pickup in treasury volatility as well, which is interesting that it's happening at the same time as the 10 years broken through 4, right? You're seeing vol pick up, treasury vol pick up as the yields are improving, but just craziness in dispersion, right? And in correlation. So I've been adding protective puts in EM. I've been stopped out and selling out of any trade that's I feel is close to being the next sort of shoe to drop in the deleveraging. I had a position in the Korean utility KEPCO that I got stopped out of last week. I'd been running trailing stops as it's sort of been as it's been chasing those DRAM stocks in Korea over the past 6 months. And actually, I'm kind of relieved because if that Korean bubble does pop, I mean, the whole market goes bidless for a while. I won't even be able to shift my utility at 3 times forward earnings. So actually, I was just happy to take that one to the cage, right? But the scenario you paint where, this carries on for a week and equity risk assets start to get really concerned. Yeah, I think you have to assign a decent probability to that.
yeah, so I mean, I guess let me just go back to this concept of the 4 horsemen, right? If you think about like Liberation Day, okay, we had this like deleveraging event, and then since then, most of that rally was not really, the capex from the AI that was real, right? But most of the rest of it was just vol suppression, dollar suppression, oil suppression, and credit spread suppression, right? And now we have all 4 of them going in a direction, and you see implied correlations rising. Now on the right, go back to that real quick. On the right, I made a little funny thing. If you follow me on Twitter, that's the 1 month skew, 25 delta skew. So that's 2 years of rising skew. So there's definitely a supply situation there that has changed, because you see they tried to bring that back down many times, and just that's like a bull market chart, and it's like, oh, we're trying to take silver down. Well, spike it down. No, we're going higher. We're going higher. You know what I mean? So be aware of that. Also be aware of that when you're trying to just buy puts, because skew is it's not like insane, but it's definitely elevated relative to what it was in 2 years ago. And so that's a dynamic. Spot vols rising. Move actually has picked up, and Move had been like a wait. So Move is the rates.
Yeah, that's what I was saying. Yeah, I mean, it's just interesting. I mean, you don't normally see, we're seeing bonds up, bond vol up, right? That's quite rare.
Exactly. That's how you know this is different. And in the first chart, I showed you the chart of the SOFR, and I have a huge position in the SOFR, a huge position in the credit default swaps. They're moving right in kind, and that is not the kind of thing you see unless it's a deleveraging type of like situation, or where people need liquidity, like a liquidity thing. So that's kind of the tell on that, basically. So you have all these things, these three going against you now, with the AI concern, with the fact that it's like, okay, well, the CapEx get an ROI, with the fact that like basically valuations for the index level are super high, and the index is basically pinned, so we have this insane dispersion. And so the index down 1% right now, but like it's still at 6,800. 27 times trailing earnings.
I've got a great idea. Let's drop 75 yards of SpaceX concept paper on this kind of market, right? Let's do it, baby. I sent out my start the week note a bit earlier, and I sort of pulled down. I got a bug in my bonnet thanks to our buddy Mike Green last week, and we'll talk about this in a second because he highlighted that the Nasdaq 100 is about to change the rules, and I'll talk about this in a second. So let's assume that Elon gets his bogey of $1.5 trillion as a valuation for SpaceX, and he floats 5% of it. That's $75 billion, right? That SpaceX is at 1.3 on noticed right now, and this is the largest 25 IPOs of all time. So a $75 billion IPO by SpaceX is 3 times the size of Saudi Aramco, right? Saudi Aramco, to get over the line, required the participation of pretty much every sovereign wealth fund on the planet and a bunch of princes in Riyadh doing national service big time to get that stock away. Right? And we're trying to get this deal plus Anthropic plus OpenAI, right? All of which are crazy content. Now, I mean, just to put, $100 to $125 billion of US primary paper in context, right? This is US IPOs, and people might point to 2021, but most of that was bullshit paper, SPAC paper from Chamath, which is people buying treasuries, right? At the end of the day. So 2021 is not a precedent, and it's happening just as, well, by the way, the bankers are panicking, right? So Mike Green wrote a great letter to the index committee, which spurred me into action. I wrote one again. Essentially, they're trying to create new rules in the Nasdaq 100. So effectively, the SpaceX, OpenAI, and Anthropic IPOs can get tipped straight into the triple Qs, right? Maybe via a couple of days sitting on a fast money hedge funds book as they wait to toss it to Invesco, right? I think this would be a serious mistake for the crown jewel of global capital formation, which is the US capital markets. I think it'd be a massive mistake. Read more about it on my in my letter, which is it's in my Twitter profile if you want to see it. The thing about, do you remember when we had Louis on the other day and we were talking, he was joking that it was always people like Rupert that killed Chinese bull markets, because in my old job, when there were in the when a Chinese bull market came along, ECM volumes would spike through the roof. You'd have 15 IPOs a week in Hong Kong. There'd be placements left, right, and center. And it's absolutely true, right? Supply does kill bull markets. Now, the thing about the US market is that it's effectively been de-equitizing for most of the last 20 years as the US market becomes increasingly financialized. Now, the primary outflows have been companies being taken private by private equity, right? But also the phenomenal drip pace of buybacks, right? So most of that buyback by volume has been coming from the hyperscalers. Guess what? They're building data centers now. They don't have the same kind of budget to buy back shares, right? So that buyback bid is going. Then you've got people like Dorsey firing 40% of their workforce. Now, that creates two supply effects, right? One, there's no more drip 401k money going back into the market. And guess what? These newly sacked software engineers now have to sell their vested stock to start paying some bills at home, right?
Right.
So that's bothersome.
And let me put a little comment. Go back to that chart. I'm just going to make one comment.
Yeah.
You see the two periods when there was actually equity supply growth. It was post GFC and it was post COVID, right? When we had to recap all the consumer and luxury names. Yeah. And in 08, it was all the financials, right? And so, you know, there was a period there where you had to absorb that before things really got going again. You know what I mean? So the supply thing is a real thing that has to be like, and it's so funny because when you think about, you know, I have a CFA and MBA, they never talked about supply. You know, few people really, and maybe that's a dirty secret of Wall Street. They don't want you talking about supply. The denominator, don't talk about that.
Well, I think it's a really real effect, right? Like any shares are just like any commodity. Price is decided at the marginal supply demand, and I'm telling you that in a naturally increasing supply demand, we're about to drop $150 billion of unseasoned concept valuation, space and AI paper onto a market where the market props are falling away. Now, I made this point about the M&A bid, and I've had a terrible trade. I thought that Liberation Day would kill the M&A deal calendar. And, you know, these M&A boutiques just rallied in my face. But look what they have been doing year to date, right? Suddenly, that trade is starting to work. But this is feeding into the, you know, these guys make money when they are doing, you know, LBOs, right? And there ain't no money for the LBOs. So yeah, we've seen a little bit about I just worry about those three props to leave it with a visual.
You know, it's funny you say that about the supply, because that's one of the things that's held up the high yield as well, is that, you know, and you know, IG to some extent as well, is there was just more demand than supply. And so it was like people were like, oh, the tights. And, you know, I made this argument when we started taking this position a year ago, and it was like, but I think now we're coming in a refi window. Plus, you know, even with these private equity guys, you know, I saw some dog shit triple C that dividended out and did like one of those kind of transactions with high yield to pay them. Like, start seeing that kind of paper come in. You see a lot more debt, as we've talked about for a while, from the now the debt funded data centers. Like, there's some supply in credit and supply in equity in a time where asset values are kind of rolling for the most part, unless you're gold, you know, which gives no F's about anything. But like,
I tell you what, if I was sitting on the New York equity syndicate desk at Goldman, I'd be sweating bricks right now. I don't see how this stuff gets done. I mean, it's you know, it's all very well sort of rigging to dump into passive. I don't think that covers the bill. The other thing is, you know, these private markets, I mean, yeah, they're tough to trade, but the active institutions that really wanted to own SpaceX have found a way to buy it already several years ago, right? Less the case with the newer AI companies.
I think Barron has like 50% position in SpaceX or something like that.
I think it's a third of his. I think it's a third of his.
Yeah, whatever. It's some ridiculous number.
Crazy Kathy owns a ton. Your old boys, your old boys at Fido, they own a lot, right? In the Contra fund.
I mean, I'm nothing against the company. It's just like, I think that the market really needs to get that paper out, and they're, you know, really hoping that like things don't roll here. And in the very dreaded, by the way, this decade, the Q1 is my favorite quarter almost every year. Like, I don't know, maybe I should just only trade in the Q1, to be honest.
Take 9 months off. Take 9 months off. Have a baby, right? I mean, ultimately, what ultimately I reckon, Ben, is what we need to think about is with this deleveraging, with this extra supply, you know, anything that's not nailed down has to get sold to make room. So I'm really concerned about this supply demand imbalance. Question for me is, does that affect spillover into other global equity assets, right?
Right. Yeah. So you think about to tie this into what we were talking about with kinetic deleveraging, right? Like if a balloon is expanding because the four horsemen are allowing you to have this like grease, if you will, of leverage. Because remember, volatility is really just the true price of money in markets. And I don't want to get too deep into that, but like if volatility is rising, that's deleveraging. If oil's rising, it's deleveraging. If credit spreads are rising, it's deleveraging. So you need, if these things are all going down, and we can talk about the dollar last because the dollar is the big wild card. But like if these things are going against you, you're basically in a situation what Rupert's talking about and our buddy David Dredger's talking about, where we're in a Hunger Games scenario where everybody needs capital, you know, and it's going to be a dogfight or a knife fight for that capital. And you know, if the way to get it is, hey, we got to issue more credit, or if we can get the equity market. And so everybody kind of trades down from, hey, if you're a senior loan guy, now you're in the you know, kind of the bond market. And if you're a bond IG guy, now you're in high yield, you're a high yield guy. Now you might have to be doing some equity, et cetera. If you're private credit, you might have to consider a new career. You know,
they're competing with the crypto guys. Competing with the crypto guys for those price chef jobs.
But yeah,
what do you want to say? What do you want to say about the dollar? We're just running into time now, but what do you?
And that's the fourth one, and probably the most important one, right? In the red is the dollar inverse, and then the black is Nasdaq divided by S&P. I like to think about Nasdaq divided by S&P as kind of a measure of expansion or contraction, right? Leverage or deleverage, and this kind of shows you well. And again, the dollar's got dirt napped for a year now, but it's kind of hanging in there. And you know, we'll see. And like, I'm not like I'm a dollar bull, but I'm not like not nearly like I'm a bond bull, right? I'm mega bond bull, but I'm not as bullish on the dollar as I am that. And so this will be, if the dollar starts rising, and I know it's up right now in the overnight pretty strongly. If we start getting this, it's a real problem.
37 bips in the Dixie I'm seeing right now.
Let's not talk about the euro. I mean, like whatever. Fine. Point is, it's up decently, and I don't really, not trying to say one thing or another about the dollar, but I think this is the wild card to keep an eye on. Like, you know, the dollar weakness can offer a lot of assistance, the way lower rates can offer assistance, basically, and so that might be what they try to do, like they did after the TMT, you know, and just prove Rupert right. The dollar goes down. This kind of saves some of these issues we're talking about. But I think that's the wild card to keep an eye on of the four, because that's kind of sitting there. But if that starts ripping, you know.
Yeah. Don't worry, Benny. We'll have a whole show dedicated to the squirrel being right when it happens. Okay. Listen, buddy.
I'll do my push-ups. I'll do my push-ups for you, buddy.
It's time for you to go to bed. It's time for you to hit the air raid shelter. And we've been a half hour. Thanks everybody for joining. Lots of you today. Fantastic. We will see you on Thursday. Remind me, who have we got on Thursday?
Who we got on Thursday? I think.
Oh,
talking about Japan.
Yeah. We have got Mateen Chowdhury. Who is also an Aussie resident and a Brit resident in Australia. He's also a Japan expert. So we're picking stocks in Japan publicly on Thursday. Join us. Benny and the Squirrel out.